Welcome back to the channel. My name is Steven. I'm a pharmacist and I own 54 units of real estate. I've been investing in real estate for 8 years now. Sorry, I had some technical difficulties earlier, but today I want to talk about creative financing and how I used creative financing to scale my portfolio initially, as well as to help me scale in the future if I decide to scale. So, just to be clear, right now, I'm not focused on scaling. I'm more focused on optimization of my portfolio. I'm more focused on trying to get more cash flow. So, to really improve lifestyle. So hopefully this mic works. Can't tell. But to me, I learned two creative financing strategies recently and want to share with you guys. So the first one is called the lazy burr. So the lazy burr is when you buy a property all cash. So it's a new construction property that you're buying completely all cash. And when you offer companies like Lennar, like DR Horton, all cash, typically you will get a significant discount. So I've been able to negotiate 20% off of the original price. For me, for example, if let's just say a new home costs $300,000, I typically will try to negotiate 20% off. So that's about $60,000 off. So I'm hopefully buying this property all cash for $240,000. And what I did in the past was once I bought it all cash for, let's say, 240K, which is 20% off, I would then do a cash out refinance once the property is occupied of a tenant, and I'm doing a debt service coverage ratio cash out refinance. So the downside of a cash out refinance is number one, the interest rate's going to be higher. Number two, the fees are going to be higher as well. And number three is the what was it? You get 75% LTV based off of the ARV. So typically the ARV, the after repair value, is going to be roughly the original purchase price of around $300,000, right? So you take 75% of $300,000, and then I got a basically 6.625% interest rate. There's a 5-year prepay, fixed over 30 years. I think my monthly payment is around 1,600. I forgot off the top of my head. But pretty much, I basically left some money in the deal because the new loan was probably around $230,000 roughly. So I left some money in the deal, and basically was able to recycle my capital or most of it, and then you can use that to go buy another deal. So obviously, this is basically the lazy burr, where you're recycling the same capital that you have in order to continue to buy real estate. So this is a way to leverage. This is a way to scale if you're in the growth mode, if you're in the scale mode, and that's what your goal and objectives are, right? Just to be clear. So you basically take that same capital, you pull it out, you buy another property, and you rinse and repeat this process. But the downside of this strategy right now is you have to buy in a cash flow market, and most likely you're breaking even on that property. So, you're breaking even. Like my property, I probably make about 150 to 200 bucks a month, but realistically, it's being set aside for future repairs, future reserves, and future vacancies. So that's kind of what people don't really think about. So it's kind of a long-term play, right? So for someone like me who wants to optimize towards, early retirement, who wants to optimize more towards cash flow, then I basically, it's not really a good strategy for me unless I just made so much money elsewhere that, I didn't need to live off my cash flow income. So that's kind of the, I think, fork in the road I'm stuck at is I feel like I'm the type, like reflecting on myself, like I cannot sit there and then do nothing and basically not work in a capacity or not earn money in a capacity. So even if I retire from my W-2 job, which is a pharmacist, I still feel like I'll be involved in trying to make active income, whether that's becoming a real estate broker, whether that's continue to create content and find other ways to basically make additional streams of income. So I feel like I'm that type to like sit. I can't sit there and do absolutely nothing. right? I have to do something to feel productive and to feel like I'm contributing and to, basically make active income. But obviously, if you have real estate, you're not as pressured to um, make money, right? Like you don't like I don't need my pharmacist W-2 to do that. So that's the kind of the point I'm stuck at because obviously if I um, didn't want passive income to retire early from real estate, I could continue to scale using creative financing if I had a long-term approach, if I was willing to be patient, if I was willing to wait like another 15, 20 years to basically retire, like this is an option. So, to kind of summarize my lazy burr earlier, you're basically buying a new construction all cash. And then once you get rented out, you're going to do a cash out refinance using a debt service coverage ratio loan. And you're going to pull out 75% of the original purchase price. So you end up leaving a little bit of money in the deal. So you're probably going to leave on average, probably about 8 to 10% in the deal. But I kind of learned a lazy burr 2.0, which somebody taught me. And it's kind of a slightly the same concept as my original burr, but you're instead of doing a cash out refinance, you're doing a rate and term refinance. So it's a slight modification of the strategy. So how does this strategy work? So it's the same thing. So let's just say the original purchase price from the NAR is $300,000. Because I'm offering all cash, and remember, cash is relative, right? It could actually be cash in your bank. It could be a private money lender. It could be a line of credit against your stock portfolio. It could be a line of credit against your whole life insurance. It could be financed through your self-directed IRA that you could use to be a private money lender, right? So cash is very relative. But I'm just saying cash because it's the easiest to understand. So basically, you buy cash, and then what you do is let's just say I have the cash available in my account. After I buy the property cash, shortly after, I'll put a promissory note, a mortgage, a first lien on the property that's owned by one of my LLCs. So basically, I'm putting a note on the property so there's a first lien position, but I am the one that owns or controls that first lien position. So then, because there's a first lien position on this property, you're not doing a cash out refinance. You're doing a rate and term refinance. So for rate and term refinance, the advantage is that you're typically going to get a lower interest rate. It's going to be typically 1/8 of a point less. Your fees are going to be less. But what's more powerful is you can do an 80% LTV rate and term refinance based off of the ARV. So now, if basically I got a 20% discount on this property. So if that property works, and basically I get 20% discount, and then I put a note on the property, I put a mortgage on the property, first lien. I'm going to engage a debt service coverage ratio lender. And then once I have that debt or that lien on it, I'm going to do a rate and term refinance, do 80% of the original purchase price based on the ARV. And basically, I pull out all my money on the deal. And then the new lender will pay off my first lien position, which is me, myself. So basically, this is kind of a more upgraded way of the Lazy Bird 2.0. So the only difference is instead of doing a cash out refinance, I'm putting a mortgage on the property, a first lien position, which I control. And then I'm doing a rate and term refinance. So the rate and term refinance is going to allow you to have a lower interest rate, less fees, and 80% LTV of the ARV. So this way, it's a perfect burr. So, I'm very tempted in doing this because I like to really test concepts before I do it. But at the same time, I'm trying to hold myself back from scaling because I'm at the point where I don't want to scale. I just kind of want to repay my portfolio to be easier. Like I said, it's hard. Like I'm a type where I like to push the limits and really push myself and see how far I can go. But I kind of hit the point where I just want to chill and scale. So this is the Lazy Burr 2.0. And it's really crazy that, um, this is a way that you can do. And I learned this from somebody who said, like, dude, like, this is how he scaled. Like, he just shared exactly what he did. He basically, bought properties cash using his self-directed IRA. And he then put a first lien position or mortgage on the rental via his self-directed IRA. And it's really, basically a way to go. So like I said, this strategy is highly leveraged and it builds you equity, it builds you appreciation. But just to be clear, like with these interest rates today, the cash flow is going to be very low. It's going to be a break even deal, right? Like with some reserves. So it's a way to build wealth. And, basically, it's not a way to get cash flow of these interest rates. If interest rates were sub 5%, you'd probably cash flow a little bit more, right? So just to be clear, there's a way to, build your net worth, not really for cash flow, right? So this is one strategy that I learned, and it's kind of crazy. Like if I was in scale mode, if I, just wanted to build long-term wealth and didn't care about the cash flow, um, I could buy one of these properties every 3 months, right? Why every 3 months? Because I think it's gonna take me 3 months to essentially, get the property rented out and then to get the lender engaged, right? So that's one way. Another kind of creative financing strategy that I've learned about recently from another investor. So this was nice about connecting with other investors. And basically, let's just say, I want to buy an apartment complex. And let's just say, they want $1 million for this apartment complex. But in reality, if you look at your underwriting, if you look at, the NOI, divide by the cap rate, maybe the value is $800,000, like realistically. So, but let's just say the owner is really fixated on $1 million. So they want their price, but then you have to pick your terms. So what I kind of learned was, let's just say, okay, you offer this person $1 million. So you're kind of overpaying on the property because you believe that you can raise the NOI, you can believe you can increase the income, lower the expenses, and force appreciation, right? Because you're a good operator and that maybe you have an unfair advantage or whatever the case. So you think it's still a good buy, right? So if it's $1 million, what they do is you create an LLC, a joint LLC. So you as this or the seller will have 49% ownership of this LLC, and then the buyer has 51% ownership of the LLC. And then what you do is you put the property in LLC, and then you engage a lender, right? And typically lenders will allow you to do a probably 60% cash out refinance of the value. And, typically you get 60% because it's commercial. So, with single family homes, you get 75%. With commercial, it's probably, 55 to 60% because it's a higher risk property. So let's just say you're able to get a 60% cash out refinance based on the $1 million. So your new loan is going to be $600,000. So let's just say the prior loan was $400,000 for easy math here. So basically, you cashed out refinance $200,000. So with that LLC structure, what you're going to do is that $200,000 that you cashed out refinance after paying off the first loan, that goes to the seller. So the seller gets $200,000 cash out refinance, tax free, based on that LLC structure. And then what you do is there's still that $400,000 that's remaining, right? And what I was told was you can basically that the buyer could put one of their assets that they have that have a lot of equity. So that asset needs to have $400,000 of equity on there. Then you could put a second lien position on that asset and then charge an interest rate. So let's just say it's 6%, for easy math here. So basically that's going to be 24K a year. That's about 2,000 bucks a month. I think that's the math. Correct me if I'm wrong. So basically, the seller gets $200,000 tax free by doing the cash out refinance, and then they're getting the $400,000 in second lien position at 6% interest. So that let's just say it's 2,000 bucks a month. So I was just like, interesting. That's an interesting way to do that. So why does that work for the buyer? It works for the buyer because they're going in with zero money down, essentially, right? So it's a creative way to buy real estate. Yes, you're probably paying a premium to get that zero down deal because they're using a cash out refinance based on the value. And then also they're putting one of their assets in second lien position. So they're coming in with no money in the deal, right? But obviously their money has to be paid in terms of like if there's renovations needed for their apartment complex or whatnot. But they're going in with basically no or low money down, right? But for the seller, it's advantageous because you're getting a higher price, which is good, but also they're able to kind of avoid or delay some of the taxes that they get. So once I kind of learned this strategy, I was just like, oh my God, maybe if, 'cause, if I want to sell my 20 unit, I could sell it creatively in this way as well. Right. Like I don't prefer to do a second lien position because I have a second lien position in my mobile home park. But to me, if I were to sell my 20 unit, what's the objective of me selling my 20 unit? It's to cash out some money, pay taxes, and then use that to go build 2 ADUs in Orange County, where it's a great rental market. And if I own those ADUs cash or mostly cash, then I could basically, rent it out and that would be pure cash flow. Because with ADUs free and clear, your property tax doesn't go up much, your insurance doesn't go up much. So if I'm able to rent out the ADU for, let's call it $4,000, but it cost me 350K all in with all fees and permits to build a 3-bedroom, 2-bath ADU in the backyard, it's a pretty good return on your money, right? I think it's like 15 to 16% cash on cash return. So that was my goal. But hey, if I could sell a 20 unit that, let's just call it breaks even once you factor in reserves and repairs, I can basically get $200,000 in that example in my pocket, and that can probably build most of the ADU, not all of it. And then I'm getting 2,000 bucks a month cash flow from second lien position. So that can help fund the HELOC that I'm using to bridge the difference of the two between, about 150K, which I'm short. So like that's an interesting concept that I thought about. And then once I pay off that line of credit, then I'm getting that pure cash flow on that ADU. So I was like, interesting, right? Like that's an interesting way to sell it. But obviously you have to find someone that works with this. So like these two concepts I just learned about like recently, and it's kind of like been blowing my mind because, if you've been following my content lately, I've been talking more about scale. I've been talking, or not scale, the opposite of scale. I've been talking more about like optimizing my portfolio. I've been talking about taking chips off the table. I've been talking about selling some assets to own some free and clear. I've been talking about increasing my cash flow significantly so that I could be optional to not work for my W 2. But it's been kind of funny. Like I would say the past, I'd say week, like, or this past like year in 2026, I've been really simplifying, optimizing my portfolio. And how am I doing that? So, I have a video recently talking about, I went a little bit too crazy of LLCs, right? In California. And in California, for every LLC you own, you have to pay the franchise tax board $800 a year. And then LLCs, in my opinion, don't really give you super a lot of asset protection, specifically in California. So what I realized was I was better off dissolving my LLCs for my rentals in California and using that money instead, the $800 a year that I'm paying the franchise tax board in California, to buy an umbrella insurance policy. So that's exactly what I've been doing. So I've been basically been, drafting up the grant deeds to basically transfer the properties out of my LLCs into my trust. And then once it's out of the trust or out of the LLC, excuse me, then I can engage, umbrella insurance companies. So I was kind of quoted roughly, I think 1,500 for a $5 million umbrella insurance policy. So basically, if I dissolve two of my LLCs, that's going to save me 1,600 bucks a month or a year, excuse me. And that's enough to cover my umbrella insurance policy. And, in reality, when attorneys come after you, they want to go after the insurance policy. So your property doesn't have insurance, and then you have an umbrella insurance on top of that as well. So that actually gives you more asset protection versus an LLC. So once I kind of realized that, I was like, okay, well, I was oversold these LLCs from an asset protection attorney. So I simplified that. I've also really been honing my expenses. So now I really watch my income and I really watch my expenses. So in full transparency, I gross about 50 to 55K per month on my rentals. But depending on the month, it could be break even. It could be maybe making 5,000 that month. So I just say overall for at least 2025, it's probably a break even rental portfolio because my portfolio is not catered towards cash flow. It's catered towards appreciation because in the beginning of my journey, how did I scale to 50 doors? I basically built up a lot of equity in my single family homes during COVID, did a huge cash out refinance. What happens when you do a huge cash out refinance on a single family home portfolio? You create a bunch of alligators, right? So I basically stripped out a lot of money. And then my family home portfolio was probably negative, maybe 3,000 bucks a month collectively in California. Because in California, you get massive appreciation, not much rents, right? Like, for example, the first property I bought for 800K in 2017 is now worth about $1.4 million. So that's $600,000 of market appreciation doing nothing, right? That's the perk of investing in like a high cost living area, like the Bay Area. However, my rents only went up from $3,700 to today, it's about maybe $4,300. So it appreciated like crazy, but the rents didn't really go up that much in that specific market, right? So because of that, like I stripped out a bunch of equity and I used that to go buy my 26 unit apartment complex, which averages 5,000 bucks a month. So I used that to go buy my mobile home park, end up losing $100,000, but now I get a monthly second lien position of 2,000 bucks a month. I use that to go buy my 20 unit apartment complex, which is, I call it a break even deal because, I make money some months, but some months I'm losing money, but overall it's a break even deal. So if you kind of look at my portfolio overall, it's very, very um, appreciation focused. Like I built multi-million dollars net worth from my real estate portfolio, but the cash flow is very weak and I haven't had to live off the cash flow because I make a lot of money through my W-2. So I'm just living off my W-2 income. But, now I've been like kind of repivoting my portfolio. So in a way where I've tried to sell some to then, focus on cash flow. So ADUs and building one or two ADUs, maybe one to start in the backyard. And then eventually I'll convert the garage later if it makes sense. And those ADUs would be owned free and clear, which will improve my cash flow. So that's kind of the point that I'm getting stuck at. Like I want to optimize my portfolio to go more towards cash flow. But I keep on thinking back and forth. And that's why people say I'm contradictory. But, for me, you know, it's like a pros versus cons. And like I think my nature, unfortunately, what helped me build this net worth, what helped me build this real estate portfolio is that I'm a go-getter, right? Like basically I things to the limit. Um, so basically it's really going in and it's really um like finding ways to scale. Like I don't want to partner, I don't want to syndicate, I don't want to raise private capital. Like that's too much of a headache for me. So um, for me, it's really like just about pushing the limits as far as I can go without anyone myself, right? And I was younger when I was doing it, right? I'm 25, 30. So for me, that's the way I think. So for me, in order to think for optimization, to think for chill mode, it's really rewiring of my mindset, which is like hard to do, right? It takes a while because I'm so geared towards scale. That's why I said it's more natural for me to say, hey, you can do this lazy burr, buy rental every single quarter. Yes, it's going to break even, right? Initially, but if you're patient and you get this for 10, 15 years, at that point, you're probably going to be making good cash flow, right? Or I could just buy apartments, the strategy I outlined earlier, where, we're doing the LLC with the buyer and the seller, and then basically you're doing cash out refinance and I'm leveraging my assets, which has a lot of equity to offer a second lien position as cross collateral and offering interest rate to then, scale and to buy. So, I have a video that I made recorded. It's not out yet, but it basically talks about like what I would do if I wanted to scale. Like with my assets, I could easily go from 50 doors to probably 100 doors if I wanted to do that. Right. So how would I do that as a preview? I could do a huge cash out refinance on my 26 unit, take that money and go buy an apartment complex. I can 1031 exchange these high equity single family homes that don't really cash flow into another like 30 unit apartment complex. So if I want to scale, I can go that. But I'm at the point where like I said, I'm at the fork in the road. Like, how do I want to pivot? And so far, it's just been towards cash flow, right? Um, so so that's why I wanted to share these kind of creative financing strategies for those of you who are in your scale phase, where you just want to scale and you want to build long term wealth, which I've been good at, but I've probably been weaker at optimizing for cash flow. So that's what I've been now focusing in on now. So hopefully you kind of learn from the two strategies that that I've done and that I've kind of hit recently. Like I said, like I'm just so tempted to like just do it myself just to prove the concept. But I know if I get unit number 55, it's not gonna make me any happier. Right. So like it's for me trying to focus on optimization and I guess embracing this boredom. But it's very hard for me to like sit still. I'm that type to like always be doing something. So that's why I always wonder, like, if I retire from my pharmacist job, like, I probably would be bored, and I probably would try to find to do something else, right? So it's that balance. So um, it's really interesting. So now let me take a look at these comments. So I see a comment: you can't scale because you have much equity, but your cash flow is very low. So yeah, so if you look at my overall portfolio, I have um, probably $6 million worth of real estate and about $2 million worth of stocks. Um, and the majority of it is from me. My wife contributes probably more liquidity. She's more stocks, I would say, versus real estate. And I built up a lot of wealth, but wealth doesn't pay the bills today. So what people have to do, especially if you invest in appreciation markets like what I do, like California, like on the East Coast and the West Coast. I forced a lot of appreciation of my apartment complexes where I bought it at market value, I renovated them, and then I essentially raised the NOI, which forced the value up significantly. So for my 26 unit, if you follow my channel, I bought it for $500,000, put in about $300,000 to renovate it. I was able to raise the NOI significantly because the rents were under market. And then now it's worth about 1.6 to $2 million is the range that I'm getting quoted, right? So I basically made about 800 to $1.2 million of forced appreciation on this property. Um, However, that deal on average probably cash flows about 5,000 bucks a month, just that rental itself, right? So you could say that, well, it's a weak return on equity on that deal. But like I said, I basically mastered appreciation between forced or market appreciation in California, which you chalk it up to luck, and then forcing appreciation on my apartment complexes myself. However, like I said, appreciation, equity doesn't pay the bills today, so you have to repivot that equity, that appreciation into cash flow. So how do you do that, right? So I've kind of run this scenario before. So let's just say I were to sell my 20 unit or my 26 unit, and let's just say for easy math here, it's worth $2 million. I have $400,000 in debt, rounding up, so it's about $1.6 million of equity that I have in this deal. And let's just say I sell it myself. I don't use a realtor because most realtors are useless. And I tend to exchange it. So let's just say after that, I have about $1.5 million that I could use to actually buy rentals. So if I do a 1031 exchange, I have to buy at least $2 million of real estate. So what does that look like? If I were to go in Huntsville, Alabama, which I currently own in, $2 million is going to get me about probably 7 rentals. Let's just call it about 7 rentals. And of the 7 rentals, I would say 5 would be free and clear, owned completely cash, right? So out of the 7, 5 would be free and clear. And then the other 2 would probably have some sort of leverage on it, some sort of debt on it. So in this example, what I just say, my 26 unit averages about 5,000 bucks a month. So now let's calculate the cash flow of this portfolio if I were to 1031 exchange it into 5 free and clear, 2 leveraged. So the 5 free and clear would probably rent for around 2,100 is what I'm getting. And if I'm paying property tax, it's about 200 bucks a month because it's cheaper in Huntsville. The insurance is about between the insurance and the HOA, it's going to be about probably 100 bucks a month. The HOA is $400 a year, and the insurance is around 600, 700 bucks. So let's just say it's $100 between that. The property management is going to be about another 10%. So what is that math? That's roughly about 500 bucks. So if I'm doing 2,100 in rents, let's just say I have $600 in expenses. So it's about 1,500 bucks a month in cash flow per paid off rental, right? After factoring your fees. So if you have 1,500 per paid off rental, and let's just say you own 5 of them free and clear in my example, that's going to be 7,500 bucks a month in positive cash flow from those 5 paid off rentals. And let's just say the 2 of debt and leverage is calm break even, factoring in capex and reserves. So that $7,500 of cash flow, let's just say I set aside 1,500 of that for future repairs and future reserves and future vacancies, which should be very minimal because it's a brand new property, right? So the biggest concern is going to be the vacancy. So that's $5,000 a month in cash flow, the same as my um, current apartment complex, but it's fewer doors. It's some paid off, so it's a little bit simpler. So in this example, like it's the same cash flow, if not slightly better, because they're free and clear. So if I set aside no reserve because I think that there's um, enough cash flow, it can be $7,500 a month. So I can make that move, right? Where you tend to exchange it into some newer assets that are free and clear. So I can rinse and repeat that process where every 3 years I can buy an apartment complex, hopefully a good deal, stabilize it, fix it up, raise the NOI, and then 1031 exchange it into paid free and clear single family homes in a more of a hybrid appreciation / cash flow market like Huntsville. So I can rinse and repeat that process if I wanted to do that. So that's something that I've been thinking about as well, because with C-class apartments, for those of you who are new to it, it's a lot of capex, right? So like, there's some years, like for 2025 has been a challenge for capex for me, but in 2024, it was good. So it really depends. And that's why you get to set aside that reserve. So conceptually at a high level, yes, equity and appreciation doesn't pay the bills today, but you just can make some pivots and move chess pieces around the board to then transition to cash flow. So like the people that built the wealth the fastest have done it through forced appreciation and market appreciation, and then transforming that forced appreciation, market appreciation into cash flow later, right? Like I keep on seeing people who are like, oh, I invested like in single family homes in Oklahoma and I bought a rental in 2017 for $100,000. And then fast forward 8 years later, now it's worth maybe $130,000. So it's only $30,000 in appreciation. And I was getting like $100,000 in market appreciation every year in California at one point. So like you said, it depends what your objective is. So my goal and objective was appreciation and building up the net worth. So that's why I have so much equity with very little cash flow, right? And keep in mind, I get about $10,000 a month in principal pay down. So that's $120,000 in net worth increased for me, right, per year, and that's shadow in the backgrounds. So yeah, that's why I share that piece. So yes, equity rich, cash poor, but I can make a few moves and become have significantly more cash flow. So my sweet spot in cash flow is going to be around, probably realistically for me, 10 to 15,000 bucks a month with $5,000 a month in reserves for future repairs. And that 5,000 bucks a month in reserves for future repairs and future vacancies is highly conservative. All right. So, I think I can get to that number of 10 to 15K per month net plus $5,000 in reserves pretty reasonably in the next few years. So to me, how I kind of envision it is going to be about $40,000 in gross rental income. Right now I'm about 55. My expense is going to be about $20,000. So this is your mortgages, your property manager, and all that. So then I'll have $20,000 a month net, and then of which I'll set aside $5,000 for future repairs, future reserves, and 15K will be what I can live my life off of, right? And that's only one half of my net worth, right? I have my stocks. By the time I retire, it's probably gonna be closer to 3 million. If we take 4% of 3 million, that's 120K. Divide that by 12, that's 10K a month. So 10K a month from my stock portfolio, 15K a month from my real estate portfolio, right? And that's basically my retirement portfolio as a combination of both. And I hope to do that with a paid off primary residence as well on that. So that's kind of my goal if you guys are interested. So interesting old guy, REI. Thanks for hopping on. Yeah, so these two creative finance strategies I mentioned earlier, so Lazy Bird 2.0, as well as performing LLC to do kind of creative financing with a seller. Yeah, I just learned those recently as well. Andrew Paulo, thanks for hopping on. Don't you have bookkeeping for your rentals? You should know your exact cash flow numbers now. My cash flow for 2025 after all expenses. So for me, I do my own taxes. What gets tricky is that, when you do your taxes on TurboTax, you'll see all your income, all your expenses, you'll see your depreciation. But I think TurboTax, it factors in your principal pay down. That's considered taxable income. So it is hard for me to see. But for 2025, I think it was a rough year for me. And I think I probably was like break even for 2025 after kind of compiling all my numbers for taxes. But now I kind of like, and by now, I mean the past like 3 to 4 months, believe it or not, I now diligently track my P&L for every property. So I'm gauging to see how it looks and which properties basically I should sell, which ones I should keep, and how to repivot that portfolio to be more focused for cash flow. So yeah, it's like I said, my portfolio unfortunately was structured in a way with appreciation in mind and focused structured in a way initially that I didn't mind working until I was like probably 50s to 60s, right? But now obviously I kind of wanting to repivot and choosing not to be able to work in my 40s, or just choosing a different type of work, right? Instead of being tied to a 9 to 5, is having a job that I really that gives me more flexibility, like, creating content or like becoming um, a real estate broker. So yeah, I guess Paulo, you're sharing your cash flow. So you cleared about 50K with $10,000 in reserves. So that's about 5,000 bucks a month, which is pretty good, right? That's pretty good. So I hope to pull those numbers with my 280 ADUs that I build and own, um, free and clear. Um, So old guy REI, principal pay down, active income. So no, it's considered passive income still, but typically offset by depreciation on your asset. So like I said, I own in California. So like the structure values are so high. So usually the depreciation I get using straight line depreciation over 27.5 years is enough to basically wipe off that principal pay down um, that I have. And what's kind of nice is that like if one property for me is, let's say it's positive, but I have a property that's like negative. When I do my taxes on TurboTax, it'll actually like it'll add up everything. So overall, it'll show you your overall number. And because I renovated my properties, like, when I'm talking about renovation, I pumped in like $300,000 to renovate my 26 unit. I pumped in probably 100,000 to $150,000 to renovate my 20 unit. Like those are depreciated over like 5 years typically. So like I have a lot of depreciation that passive losses that just carry forward every single year. So like for me, I don't have to like even if I make money in my real estate, I have a bunch of passive losses that carry forward. And eventually, when I qualify as real estate professional status, and to do that, my wife has to be retired and then managing our portfolio. That those passive losses can then offset my active income as a pharmacist, like if I go down that route. So like, we'll see. But like you said, like right now, like most of my net worth is like that 10K a month in principal pay down. So it's 120K a year. So, if my real estate portfolio breaks even, my net worth still increases by 120K doing nothing for that year, just of pure principal pay down. But hopefully over time, like you said, you want to have market appreciation. But honestly, what I've seen in California, what I've seen in Huntsville, what I've seen in Oklahoma, where I invest, is home prices have been stagnant, right? So California hasn't gone down in value, all my single family homes, but it hasn't gone up, but it hasn't gone down. So it's been kind of stagnant. So, one could argue, did California max out or is there still upward potential? I still think overall, if you can own in California, it's always going to appreciate because people want to move here. There's jobs here, and the weather's nice. But it is expensive here. It's almost better to be a renter in California. Um, but like I said, for me, um, I'm probably going to pay off my primary pretty aggressively coming up these next few years. So I'm in the process of refinancing to a 20-year term on my primary. For those interested, my current payment is about 5,500 bucks a month. I have a 69% interest rate, 30-year fixed. Loan amounts roughly around $840,000. I'm looking to refinance to roughly 832K loan, 20-year term, 5.625% interest rate. So my monthly payment's going to go up from 5,500 bucks a month to 5,800 bucks a month. But the difference is my principal pay down per month is going to go from $800 to $2,000 per month for only paying $300 more. So I'm paying $300 more per month, and I'm getting an additional $1,200 per month in principal pay down using the 20-year term, right? So it's a strategy that I want to do, and I'm probably still going to make extra principal payments on this while my wife and I are both still working, so that I can pay off this primary aggressively. But like I said, I'm still in like a flux right now. Um, like I said, obviously I have a nice W-2 job. I have golden handcuffs, and it's a huge unfair advantage that a lot of people don't have. So obviously if I continue working, like I could like just keep on paying off this portfolio, paying things down and continue to scale. But like I said, I'm at that fork and crossroad where like, do I still want to work? Do I want the option not to work? Obviously that's the luxury that I have after building up my wealth for a long period of time, but it's been a grind. So anyways, thanks for hopping on today. Just want to talk about my two kind of creative financing strategies to kind of summarize for those who just popped on. The first one is a lazy bird 2.0. So basically what you're doing is you're offering cash for new build properties. And typically you're going to ask for a 20% discount off of the original purchase price. And then what you do is you're going to be using your own cash. You're going to be using your self-directed IRA. You're going to be using a line of credit, maybe a HELOC, maybe a line of credit against your stock portfolio, maybe a private money lender to pay cash. And then after you buy the property cash, you're going to then put a first lien position on the property. You're going to put a first lien and a mortgage and a promissory note on the property so that you have a first lien position. You're going to do a rate and term refinance because it's going to give you a lower interest rate. It's going to give you lower fees. And they allow 80% of the LTV. So what'd you do? You bought a 20% discount. So basically you can pull out all your money in the deal, right? So all your money is being refinanced out and paying off your first lien position, which could be yourself. It could be your line of credit. It could be your IRA, right? And then from there, basically you own a deal of $0 in $0 of your own money in the deal, but it's probably a break-even deal, being honest, right? So it's a way you've made 50K in instant equity. You get a cash flowing deal that's break even. And then if you can ride out for 10 to 15 years, hopefully, it should go down. So, for me, that's the lazy burr. And like, honestly, like I have lenders that can do that. I have a market in Huntsville that can allow me to do that. But like I said, I'm getting a bunch of break even rentals. Doesn't make sense for me at this phase. If I was still in scale mode and want to work longer, it might make sense to do that lazy burr strategy. So hopefully for those who are in the scale mode, maybe it works for you. And the other strategy was a little bit more creative. So let's just say I wanted to buy a rental apartment complex, and let's just say they were fixated on $1 million, but I think it's only worth $800,000. So I'll give them the $1 million purchase price. We would form an LLC together, and me, the buyer, would get 51% ownership, so majority ownership. The seller would get 49% ownership, which is minority. And then what we would do is we'd get a new loan on the property. So we'd do a cash out refinance at 60% LTV. So hopefully the LTV is $1 million. So the new loan's gonna be 600K. So I'm gonna take that 600K as a cash out refinance. They're gonna pay off the first lien position. So let's say the first lien position is $400,000. So it's $200,000 left over that goes to the seller tax free. So so that's their money, right? That the seller gets. And then on top of that, there's remaining $400,000 there. So the seller is going to get a second lien position at, let's call it 6% on one asset that I own as the buyer, that they can put a lien on, and they're getting an interest rate on that $400,000. So let's just say for easy math, 6% of $400,000 or whatever that math is, it's $2,000 a month. So I get me as the seller, or me as the seller will get $200,000 tax free plus $2K a month of cash flow as a note. The buyer gets a property that they have no money in the deal because they got a new loan on there. And also they cross collateralized one of their assets of equity in there in second lien position. So hopefully that becomes a win-win situation. It basically allows you to scale in that way. So I'm actually interested in selling my apartment in this way if I can get a higher purchase price. Also, it's a way for me to buy real estate if I want to do that. So that's another creative way to buy real estate that I just learned. So, that's The TLDR of this video, if you didn't see anything else. Um, Here, are you burned out from your W-2 job, or what motivates you to want to retire early? So, I kinda thought about it recently, like, I've always, like, worked 2 jobs, if that makes sense. So, I've always worked my W-2 job, and I'm the type of person who's, like, very efficient at my job that, after, you get used to it for the job for, like, 6, let's call it a year to 2 years. Once you're used to the job, like, 80% of the job is on autopilot. Right? There's 20% of the job where, like, maybe you haven't learned it, you haven't experienced it, but you can learn it within, like, a day at most. So that's kind of the point that I hit in my pharmacy career. Pharmacy in healthcare, it's very stagnant. It doesn't really change much. So, like, for me, it's not so much burnout for my job, it's more that I'm just bored. Because I'm the type where, like, I learn fast, I always wanna be learning new things, so, like, I don't think I'm burnt out, I think I'm bored out, if that makes sense, right? And keep in mind, I'm, like, in a leadership position for a hospital, but even then, like, it gets repetitive, it gets boring, like, I'm the type to get bored very easily. Um, so, for me, I don't think I'm burnt out from my job, it's just boring to me, and then sometimes dealing with all the politics of a W-2 job and the bureaucracy, it's such a pain in the butt, right? It's just like, I'm more of an entrepreneur, like, if I don't wanna work with a vendor who's a contractor, I just don't work with them, but when you're at a W-2, there's always people that you may or may not like working with, and you're forced to work with them, right? So, like, that's just why you get paid, that's why it's called the golden handcuffs. So every time I've worked my job, I've always done something else. Like at one point, I was going to school for my master's degree while working full time. And then once I finished my master's degree, I got into real estate. So I've always worked my job and then done real estate. Right. So like I house hacked the property. So I was literally, I worked my day job and then go home and, manage my tenants in my house that I was living in. I would then go home and then, at one point I was buying apartment complexes and sending out mailers and negotiating with sellers and talking with lenders. So I've always done something in addition to my work, right? Like, and people say, "How do you do it, Steven?" Like, at one point I was literally working full time. I was commuting like 2 hours a day. I create content, one video a day. You guys follow me, right? One video a day while driving. And on top of that, I'm managing renovations on my 26 unit, my 20 unit, my mobile home park. Right? And I still have time to, like, watch sports, right? Like, I like watching the 49ers and Warriors. They both suck right now, but, like, like, I still have time to do that. I watch whatever's on Netflix. So, like, I don't like, I have a hard time understanding when people say they don't have time. Albeit, people are gonna say, "Well, you don't have kids yet," which is true, right? But, like, I just know, like, given my efficiency and how fast I move and how fast I do my life, even when I have kids, um, like, I know I'll find a way to make it work and be more efficient. Yeah, maybe the first year or 2, it's gonna be a hard transition for me, once I have a kid. But I know I'll get used to it and I'll get a system in place, right? So, like, that's why, like, part of me, it's just like I'm not burnt out from my W-2 job. I'm burnt out because I'm doing my W-2 job plus real estate plus a bunch of other things, right? So it's not like if I only had my W-2 job, I think life would be easy, in my opinion. If I just did a W-2 job, life is easy for me. But because I'm doing real estate on top of that and content creation on top of that, and now I want to become a real estate broker on top of that, like I'm just stacking all these things. And that's why I burnt out. So, for me, that's what it is. And then, for me, I thought about early retirement, like recently. I would say I've been bored, right? Like I got systems down to a pat where I could do my W-2 job, right? My real estate portfolio is pretty stable right now. Like I'm not buying more. I'm actually trying to sell some to simplify. But it takes a while to sell a property, right? Like especially an apartment complex. I assume it's gonna take me a year, right? I'm studying for my real estate broker course, but they allow me to do one course every 18 days. But I can finish the course in one day. That's how fast it is, right? So I have to wait 18 days to finish one or 17 days once I finish the course. Creating content, I do it while on my commute to work. You guys see me in my Tesla sitting there in autopilot. So like I'm sitting there at some day, like yesterday I was sitting at home, I was like, I'm so bored. Like, would I actually enjoy not working at W-2? Like, I don't know. Um, so it's really interesting seeing that, right? So um, like my wife tells me that I'm gonna be miserable if I'm just sitting at home doing nothing. So, like, that's why I'm wondering, like, I'm able to juggle everything so well, like, I can probably still continue to do my W-2, sell homes as a real estate broker, create content, and manage my portfolio, and maybe scale. If I make a lot of money becoming a real estate broker, or my YouTube blows up and I make a lot of money, yeah, I'll continue to buy more real estate and scale. So, like, it's interesting, seeing that. So, what motivates me to retire early is just giving me options in life. I think that's really what it is, and giving me freedom because we all know I get home at work at like 6 o'clock. I go to sleep by like 10 o'clock. I only have 4 hours to do whatever, of which 2 hours is preparing for the next day, shower, eating, cleaning. Like, you only got 2 hours to spend time with your wife, and eventually, if I have my kids, 2 hours with my kids. That's not much time. So that's what motivates me to want to retire early. But like you said, I feel like I'm going down the route where I'm just going to be like my own business, a solo entrepreneur, and then if I can make whatever I make through my business as my W-2, like, I'm probably good to step away from my W-2. So that's why for me, I just want to become a real estate broker that sells Lennar homes only because it's easier to sell Lennar homes. I don't want to be driving people around for that. Um, so yeah, Andrew. Oh, you got that hybrid job. I start in 2 weeks. Finally got a traditional pharmacy. Paulo, please hook me up whenever you're stabilized. Whenever you got your foot in the door, hook me up with a hybrid role. Maybe that'll extend my W-2 career because right now I have to show up to my work every day, and sit through that traffic. But silver lining of sitting through traffic is I create content while I sit through traffic. Um, and maybe lazy like Dion. That's true. That's true. Question here. Hi, Steven. Why do you need a real estate broker course to be an investor? So just to be clear, you don't need to be a real estate agent. You don't need to be a real estate broker to be an investor. I've had or have 54 units, and I've never did the real estate broker course or a real estate agent course. So you don't need to be a real estate agent, real estate broker to own real estate. Like, I actually think people who don't have a license are better real estate investors because they're focused on selling real estate and getting that quick cash versus when you're an investor, it's a long-term mindset. I'm only becoming a real estate broker because I want to sell real estate. And specifically, I want to sell Lennar homes, new construction Lennar homes, because it's easy, right? I guess I'm a lazy real estate broker. I just want to sell Lennar new construction homes because they pay great commissions, and all you do is you connect them to Lennar, and Lennar takes it from there. They do everything else. So that could be easy $10,000 to $30,000, depending on how expensive a house I sell. If it's in California, that's $30K per home. If it's in Alabama, it's $10K per home. So if I can get an easy 10 to 30K without doing much work, I'm all for it, right? I can take that quick cash and maybe leave away my W-2. And yeah, I see a comment. Yeah, Lennar has a multi-generation model I like. So yeah, they if you're in LA, they have some in Santa Clarita that I'm aware of, where they have a next gen suite. So it's like an attached junior ADU, which is a separate entrance. It's a 1 bedroom, 1 bath. So like you could, um, rent that out, get additional income, Airbnb it out as additional income, and then live in the main house. So I would love to own something like that myself. But unfortunately, where I live, that's not an option to have that multi-gen model. Um, so yeah, it's interesting seeing that. And forever his name. Don't rush to have kids. Um, you know, um, from what people told me, you don't know how long it takes to have a kid. It could be as fast as 2 weeks, or it could take you, a few years, depending on if you have any fertility issues as a couple. So, I not rushing, but at the same time, I kind of felt like I've tried everything in life in terms of like my business, investing, travel, and living my life on my terms. So, for me, I think it's kind of around that time to like, try for a kid, but we'll see. We're in no rush. We're enjoying the dink life, but if it happens, it happens. So I'm not opposed to it either way. Um, if you sell in our homes in Alabama, you got to fly to show the house to the customer. So no, that's what's beautiful. The people, and I have people reach out to me. I bought my Alabama homes um, sight unseen. I've never been to Alabama, and I own 3 rentals there. I've owned since 2021. I've never been to Alabama. I've helped 2 people in my school community buy homes in Huntsville, Alabama. They've never been there. So I feel like people just are going to buy sight unseen. So I don't think I need to be there. Right. But, so that's going to way I'm going to be a real estate broker. I must. sight unseen, because they have homes that sell themselves, or you can do a video chat on your phone, so they can show you property. So that's what I want to do. So I don't expect to sell a lot of homes, to be honest. If I can sell a few and get 10 to 30K commission checks without much effort, I'm not opposed to that. That probably pays me more than YouTube, right? Um, so, anyways, thank you everyone for hopping on. If you want to join my school community, you can do so on a free trial. Afterwards, it's $30 a month, $1 a day. I do some Q&A sessions, a couple times a month there, and there's a lot of high level, multi-million dollar net worth individuals in my community who I've learned a lot from. So these two strategies that I've talked about for creative financing, I learned from one of the investors inside my school community. So I've myself been networking a lot more and been learning a lot. So it's been nice. If you want a course on multifamily and want to buy your first little small apartment complex, I lowered the price to $300. So it's very affordable. You can go through the modules and self-educate yourself, um, and see if multifamily is something for you. Right? It's not for everybody. I bought two, so it works for me. Um, if you want coaching, if you want to use Steadily Landlord Insurance to see if you can save on your insurance policy, you just punch in your address, and then Steadily will call you next business day to give you a quote, to see if you save money. Like I was able to save probably collectively by switching to Steadily, probably $2,000 a year between maybe 4 to 5 policies. If you want to use Lending One, or you want to be connected with one of my mortgage brokers I've been working with, um, links are down below. And lastly, my email. If you want to send me an email and connect and have questions, my email is on my link tree down below. Otherwise, check out my videos. I post every single day at 8 a.m. Pacific time. And I try to do live streams here and there. I'm doing a live stream today because my wife's at work. So if my wife's listening, thank you. Hi. Um, but otherwise, hope to see you tomorrow, 8 a.m. Pacific time. Have a good, happy Sunday, everyone. Thank you so much.